I'm joined now by Ashwini Agarwal, founder Demeter Advisors. Ashwini, very good morning to you and great to have you as always with us here on NDTV Profit. Pleasure to speak with you. I think the concern right now is because of 6 months of pain, the concern right now is what we've seen in the last 6 days. Is this going to last or not? Is this a change in momentum? Is this maybe short covering we're seeing before a monthly expiry? What is your sense?
Morning to you as well, and thanks for having me on your show. My sense is that, Nikunj and I was speaking, I think, a month ago, maybe. And at that time, I had said that it's time to start nibbling in and be prepared for a 15 to 20% drawdown in individual stock prices. And obviously, I didn't think it would play out exactly along those lines, but it did. I continue to think that the correction seen in the last 6 months has brought a lot of stocks to very interesting levels. And on a bottom-up basis, I think the worst is behind us. Will we go back and test those levels one more time because of Trump tariffs that are expected to kick in on the 2nd of April? I don't know. It's very difficult to tell. Also, remember the FX has been very volatile and the US market has been very volatile. Overnight, we saw strength in the US markets. And if the US dollar were to follow suit, you might see some short-term pressure on the Indian market. So effectively, I mean, what I'm saying is that we've seen a very nice rally. There could be a little bit of a pullback from here, basis what we see on the tariffs next week and what happens in the US. Uh, who knows? I can't say. Longer term, I think I remain quite constructive. I think the domestic economy is doing fine. We will obviously slow down as the world slows down. But I think the domestic economy looks okay to me. I think a lot of valuations are reasonable. So I think from a medium-term perspective, I feel more confident that 25 might turn out to be an okay year.
25 might turn out to be an okay year. Interesting. The worst is behind us, says Ashwini Agarwal. This is Tamanna here, by the way. Ashwini,
Yes.
my question is, what has changed? What has changed in the last 2 weeks? And I'm not sure what conversation you're referring to, but the fact is that 2 weeks ago, everyone we spoke to said economy bad, we don't know what Trump will do, Q4 bad. What has really fundamentally changed in your view? Or has there been a re-realization that the India story is intact?
No, I think prices do their own thing, right, Tamanna? So if you think about it, you have stock prices that become weak and drive sentiment down, and then stock prices come back and sentiment changes. We are at the end of the day human beings, and sentiment drives a lot of the narrative. I think what I'm referring to is the fact that domestic demand seems okay. I think that is something that we have to remember. Second is, if you look at a lot of sectors, whether it's consumers, I mean, I overheard the last bit of conversations that you were having with the CFO of Radico Khaitan. I mean, it's not a stock I own, so nothing there, but it's a domestic business. Financials are domestic businesses. Tariffs are not going to have a major impact. Maybe you'll have some incremental competition from some bourbon brands for Radico Khaitan. Who knows? But the point is the domestic economy is fine. You've seen a significant sell-off. Several stocks are down 40, 50% from their peaks, and valuations are no longer as expensive as they were. So you start feeling a little bit more constructive. I think last 2 weeks, the only thing that has changed is that things seem to be bottoming out. You're right, Q4 is nothing to write home about, but look for the rest of the year. I mean, I think it's a reasonable bet that if the Trump administration is successful in ending the two wars, we'll be feeling a whole lot better about the rest of the world by the time 2025 comes to an end. Um, will the US economy go into a recession because of all the changes happening there? I don't know. And that could be a headwind, which is why I said that, yeah, the economy may slow down a little bit if the rest of the world also slows down. But I think reconstruction of Europe, the ending of the war in the Middle East. I mean, I think these are positives that one should keep an eye on.
Ashwini, my question to you is,
Firstly, the first half of it is where the bulk of the damage in terms of the markets is done. And secondly, would you treat this as a near-term rebound, or is this just the start to the upcycle?
Okay. It's an interesting question. I think it's a little bit of both. Uh, it is a near-term rebound, and you can always see a pullback after 4, 5 days, 6 days of very, very strong markets. It's possible to see another leg down based on what happens in the rest of the world and what happens on 2nd April. But I also don't expect the previous low to be broken or the recent low to be broken. I mean, and I'm putting my neck out there. I think there are a lot of chartists out there who still expect a 21,000 on the Nifty one more time. I mean, to be tested, which would be lower than the recent low. I don't believe I'm in that camp. I think it's okay. I think with a weaker U.S. dollar, with a weaker U.S. economy, there's enough incentive for a lot of the U.S. investors to start looking at emerging markets. India being one of them. I think the domestic investor in India is anyway tied to the home market thanks to the FX controls that are prevalent and so on and so forth. So I think one should be constructive. I could the recent low be tested one more time? That's possible. So in that context, to your question, is this a pullback rally? Maybe, but I think is the bottom behind us. I think so.
So the bottom is behind us. Now, when you look at the way FIs are coming in right now, last week has been spectacular. This week also the FIs have started on a positive note with regards to India. And usually the trend is that they will look at the BFSI space as well as the IT space. Yesterday, strong moves in terms of BFSI. Today, strong moves in terms of IT. Where would your bets be? Because that's going to be the trend that the street is watching out for.
IT, I'm a little bit worried about because valuations are not that cheap in the historical context. And I think job creation in IT is going to be difficult. So companies might still do okay because they'll deploy AI, which will require less manpower to write basic code. A lot of AI or automation might be deployed in testing services. So they might be okay in terms of growing their revenue a little bit and managing their margins because of automation and AI. But for job creation, it's going to be very difficult. So, and valuations are already sort of, high if you take a long-term historical view. So IT, I don't feel, very confident about. Financials, I feel much more confident about. I think a lot of the focus on microfinance and unsecured loans has taken a sheen away from a lot of lenders. But balance sheets are much, much stronger than they were back in 2017, early 2018, when a similar sort of a scare set in. And I think the regulator has been very vigilant over the last several years. So I don't expect a lot of accidents this time around. Um, Having said this, I think for the mainstream banks, the best of the credit cost situation is behind us, and credit costs going ahead will normalize. So I think that's one factor to remember. But the moment you drill down slightly deeper, I think there are a lot of opportunities in financials, and with foreign investors coming in, as you say, IT and financial services is a big focus for them. So that might offer some tailwind.
So financials looks good. IT, you're not too sure. What about the consumption story, Ashwini? The whole discretionary consumption story. You were referring to the Radico Khaitan conversation. So you have, let me split this into two parts: the discretionary consumption and the staples. Staples, from what we're hearing, and we've put out reports this morning, looks like they're going to have a rough patch in Q4 as well. Is it a very different view for discretionary spends?
I don't think so. I think, it's going to be a gradual recovery. I don't think it's going to be a gangbuster story for the consumers as well. But I think valuations in several instances from a long-term perspective are now quite attractive. I don't think that's true for the mainline, frontline consumer staple stocks, which are still quite expensive. But I think the moment you drill deeper, again, in the mid cap space, small cap space, select large cap space, valuations are looking interesting. It's a very bottom up market, Tamanna. And my sense is that, you will see these pockets where valuations are interesting. Companies are doing all right. They're not doing so bad. And, you'll see another year pass by and the valuations will look very interesting. So what will happen is that the stock prices will probably bounce around current levels for another 3 or 4 months, and then you'll see a gradual upside with maybe a 15% return for the year, which is what I meant, that 2025 may not be such a bad year.
Okay, so in terms of this whole debate on large caps fueling the return versus small and mid caps, and I thought this was a very apt conversation to have right now, Ashwini, because small and mid caps became the punching bags in the last couple of months, saying ran up too much, destroying value. There's you're not going to get those price points back. You're seeing some recovery there, but a shaky one, if at best. I mean, even today, as an example, the broader markets are not holding up. That confidence building has not happened. What is your view on the way you're seeing and filtering companies in this space?
Great question. So, I'm not a believer that there is a large cap universe and there is a small cap universe and the twain shall never meet. Okay, it doesn't happen like that. In my view, it's all about valuations. If you find the right value with the right growth profile and a balance sheet and a management that you can trust, small caps are great, and they give you a much better alpha as compared to the large caps. I'm talking about individual investing, maybe not institutional investing, because institutions have other imperatives, including liquidity and size and the kind of money they look to deploy. So if the market is going to be driven by FIIs for a moment, let's assume that's the case, then you'll probably see large caps do a little bit better than small caps. But I think if you were to take a 12-month view, 24-month view, 36-month view, and you find small caps which have the characteristics I spoke about, a reasonable growth profile, a reasonable entry point of valuations with a balance sheet and management you can trust, I think you'll make more money. So I think it's a very bottom-up market. The correction has put some stocks in very, very good sort of perspective from a valuation perspective, whether it's financials, whether it's domestic consumers, some of the exporters as well. And you have to pick and choose. I mean, you have to decide that is this correction good enough for me to take the risk, and over a 3-year basis, can I make a 15 to 20% return on an annualized basis? And I think there's several stocks out there in the small cap universe who can give you this kind of return. So I don't think it's I hate small caps and I love large caps, or I hate large caps and I love small cap story. It's all very bottom up. Even in the large cap, you'll have a few things that will give you those kind of returns.
Okay, so you need to look at it specifically. Don't divide, broadly based on large cap and small cap. I mean, large caps are favorites because they're the safer bets. You know that those flows are going to come back very quickly. I want to also ask you, are you of the view that the FII flows have now returned, Ashwini? Or it's
I
too
can't
early?
say for certain. I can't say for certain, but I do think that the last 6 months of battering and the narrative that India is very expensive, etc., has finally run large part of its course. And a lot of it will depend on the direction of the US dollar. Historically, we've seen that a weak US dollar is a huge driver of foreign flows. By whatever the Trump administration seems to be doing, their inclination seems to be to weaken the dollar. If they succeed, that's positive for flows into India.
Okay. Thank you so much, Ashwini Agarwal. Great chatting with you as always.